Good evening. Ira Epstein of Linn & Associates with your metal market wrap-up for this Wednesday, and we're now at the 17th of February, 2021, about 6:10 p.m. Central Time. So what we saw today was a big rally in the dollar index at the expense of a number of currencies, which are getting a little bit of a bounce over on the reopening of the markets, but nothing dramatic in them. They got hit fairly hard today. But with the dollar up as much as it was, it did put this gold down. You'll see in a moment that gold is up tonight, as you can see, about $4. Silver recovered also about 14 cents. But these markets got hit intraday, but they're showing a resilience to want to come back. We have not lost the upside in the energies, as Texas is in a terrible state of events. They still don't have heat. They're losing water. It's terrible. It's a terrible way of life. Imagine all the food. You can't get anywhere. It's just a disaster that's going on. The stock market had an intraday pretty hard sell-off today, and it came roaring back at the end. Didn't close higher in most of the indices. The NASDAQ, I think, was the only one that did. But it still showed that you get these deep breaks and there seems to be a public willingness to buy into it. So as we take a look at the gold, what can I tell you other than it's the same old story? The market stays under the 18-week average of closes. It keeps the bias of the market down, because my definition, for those of you new to watching me, is that when the market is under the 18-day average of closes, that is what we call the line in the sand, that number. When you're under it on a close, you have downside bias. Over it, upside bias. It's really a filter of what's going on for you with your other indicators. As an example, I look at a chart here with nothing on it at all. And the first thing I'm going to put on typical charts is my swing line indicator. Now, what a swing line does is it will look back at the previous session, if it's a daily chart, or the previous week, if it's a weekly chart, previous 15-minute period on a 15-minute period chart. And it's going to use one of 5 rules to plot where that line goes. If you have an inside day, it does one thing, an outside day up, an outside day down, and then you got higher high, higher close days, lower low, lower close day. There's 5 rules that work with it. And it draws a line, and I use that line because you hear on TV so often, well, market's making higher highs, higher lows, it's bullish. Lower highs, lower lows, that's bearish. Do we not hear it? But where do you pinpoint those numbers? So I created a swing line indicator many years ago, so the consistency is there. I can see what the swing line is, and it tells me risk associated with the current chart pattern. What does that mean? To break the pattern of lower highs, lower lows with the market from where it's at, I got to get back over 1856.60 to break the pattern of lower highs, lower lows. Well, given where the market's at, that's about an $80 risk? $8,000 to get in there? That's a pretty big risk, right? So why get involved in it? That's my point. So you watch these things to see what they're doing and where they're going to carry you. When I look at where the market's at on moving averages, I plot the 18-day moving average of closes on a daily chart, the 200-day moving average, and the 100. Something is happening here. We know we have the bias down since the market is under the 18-day average. Remember, I just explained that. The trend is down, and now you're about to get a lineup in moving averages that is additionally bearish. Bears like to look at a sequence where if you have a bear market, the shortest, then the medium, and then the long-term average, if you will, the long-term on top. Well, you don't have that. Right now you got the 100-day average in green that is still have a higher value than the 200. If you can slip under that, you get the bearish figure. You get the 18, then the 100 and 200. That's another bearish element in the market. Let's assume the market rallied for no reason, whatever it's going to do. I would say that the resistance is wherever the 18-day average comes in. You've seen that happen before, and the market's having trouble getting anywhere from it. So when you're under it, I look for the market to have resistance at that point. If you look at the black bands I've just posted for you, they're called an Bollinger Band. You can go to Investopedia, you can go to our website. We have a phenomenal write-up on them in our free offers called Guide to Technical Indicators. And as you go through that, you learn the basics of them. The algorithm is designed so that prices will trade 95% of the time within the bands. Now, it depends on large scale, where did the band come from? You come from way up, you go down to the band, the odds are you're going to bounce away from it. You have a narrow band, and we don't have it here, but we have it in some of the financial markets. It trades a little bit differently. You're looking for breakouts. In this particular case, getting under the lower Bollinger Band, I think the market's going to move to the right-hand side of it, which tells me that the pros are likely covering shorts, looking to sell to the right-hand side. In the slow stochastic, you need a momentum indicator. Now, some people will use relative strength, others use MACD. I like slow stochastics. The word slow implies there's also a fast stochastic. Then there's different ways you can go in and modify stochastics. You may not find that your slow stochastic numbers match mine. There's a reason for it. I have a modification that I tell my subscribers about. I don't tell you, you're not a paid subscriber about it. So if you're trying to match it up exactly, it's simple, but it won't match to that. I realize most of the people use it this way. I think I found within George Linn's development of this a better way to make the mousetrap work. That's all. So what do I have here? I have an oversold market that's in a downtrend. It hit the lower Bollinger Band here, right where I'm pointing. I think the pros took the money off the table there, or had a strong, I think they took money off. If they dropped the stops down, fine. But I think if you get over today's high, you'll get more short covering. Not a change of trend. Oversold, and oversold generally doesn't attract new selling. Doesn't mean it can't, but it generally doesn't. In the silver gold ratio, in other words, looking at how many ounces of silver does it take to buy 1 ounce of gold in a perfect world of no commissions. I'm just going to do an even swap for you. Well, it takes 64.3 ounces of silver to get 1 ounce of gold. You just take the price of gold divided by the price of silver, and that tells you how many ounces you're going to need in order to get to it, because silver's priced 1 ounce, gold an ounce. So you get them on the same playing field. And that was double that earlier this year. So as it comes down, what does it tell you about silver's relationship to gold? Silver's getting stronger than gold on a relative dollar basis. Well, you look at the chart, you see that too. Higher lows, higher highs. There is divergence on this chart. While the trend is up and the bias is up, momentum is pointing down. That's a problem. I like all three going together. That does not mean the trend isn't up, but there is a fault in it. Momentum often leads price, so I'd be very leery right here. That does not mean I'm not in the bull camp still. Would I be adding positions? Maybe that's what I'm talking about. Maybe. In the copper market, I'm still in the bull camp. And different than the other parts, this market is now embedded. What does embedded means? It means that the two lines that make up the slow stochastic, they're called a K and a D line, they've been going over 80 for 3 or more sessions. And when that happens, what takes place on a closing basis minimum, it means that they've converted to being locked in, the word embedded. I could have called them locked slow stochastics. I decided to call it embedded. And again, I had shown this to George Linn, the developer, and said, I think I have a better mousetrap, and he didn't argue with me about it. Higher lows, higher highs, the market staying up against that upper Bollinger Band. This is exactly what I'm building my new enhanced Bollinger Band course on. So take a look at that. I'll let it go with this because I'm now creating the course, and when it's ready I'll let you know, and you'll be able to buy it and learn from that if you decide to play this. But this is a very typical pattern that develops when you get an embedded reading. The question is how to play it, what are the rules within it, that at least that I set up. In the platinum market, this is an overbought condition. It's not embedded. You don't have both numbers going sideways over 80. You have the market still drifting sideways overbought, higher lows, higher highs. You made a 6-year high in this market. So I think you can say that this market qualifies as one of those that is on fire, as is the copper market. It's hard to argue if you get to the palladium market that it's not doing okay. It's certainly not back at the levels it was earlier. I think you'd agree with that. On the other hand, it's still doing just fine. Keeping any of these metal markets that are going to be used for the expansion of economies, very important. In tonight's market letter for my subscribers, and that's again the paid subscribers, I give an update from the Chicago Mercantile Exchange, one of their reports. And they talk about the usage in copper, how it's used. They consume 50% of the world copper, why they think the market is staying strong, blah, blah, blah. So it's all there. But in this market, still a bullish market, you'd have to take out the low back here in order to break the pattern of a higher high to give you a lower low. Until that happens, now the market's decided, for whatever reason, that the support's so far at the 100-day average, and if it can rally, I'd look for resistance at the upper Bollinger Band. Last, in the dollar. This is a market that, coming in to today's session, had a pattern of lower highs, and I think you'd agree with me, forget this arrows here, lower low. So the key was not to take out 90.73.5. Now, remember we talk about momentum. It's like parts of a puzzle you want to be together. In this particular momentum, trend down, bias down, has not hit one of the potential targets here called a Bollinger Band. Again, 95% of the time the market will trade within it. So I think if you hit it or get right by it, the pros take some money off the table. But what's missing is you're oversold. I just told you, I don't think oversold attracts new short money. Embedded does, but not oversold conditions. Don't know that I'm right or not. If you take out 90.73.5, you break the pattern. You would then have a lower low and a higher high, and this is just what it looks like. So where are we? We're nowhere. We're caught in a market that's just waffling. It had a vertical price rise up, a decline, not a major one, came back and said, not time for me to fall apart, and the market's sort of in no man's land. You know, a tool that I use to see are certain other indicators staying with their work is the relationship of price and time. You'll hear traders talk about that also on CNBC and Bloomberg. And one of the popular indicators for it, and you have to learn how to work with it, is called the Arun indicator. And it's exactly that. You're looking to see the time frame between when the market made, let's say in an uptrend, a higher high to where the indicators are. There's just a couple of lines here that you learn to work with, and you look for divergence, or is the market confirming that it is staying within that trend. How I did it is I created for you a short video series. I think there's 2 or 3 of them. You call, we can send it to you, or you go to our website, you can sign up for it there, we'll send it to you the same way, email. So depends how fast you'd like to get it. But that's all that you really need to do. And I think you'll find it very compelling and another thing to look at. I'm Ira Epstein. You have a good day, and I will talk to you tomorrow.